Hi there, welcome to Kneppy Invest. In August 2022, as I was going through all the full-year results released by companies on the ASX, I came to see that many of the REITs on the ASX were trading at a discount to the NTA, and some of the REITs were trading at a significant discount to the NTA. And that actually did pique my interest to do a little bit more research on the REIT space, or this quite important and big investment vehicle on the ASX, because there are many REITs on the ASX. In fact, Australia, the ASX, is the second biggest REIT market in the world. And maybe I was missing something, but I've never been interested in taking investments in property for various reasons. Even though Australians tend to be obsessed with property, I was not one of those people. And I won't discuss why, but there are pretty good reasons, in my opinion, not to be obsessed with property at this point in time in 2023. But I thought I'll still do a little bit of research on REITs just to see if I was missing anything, just to understand this space a little bit more, and just to see whether a REIT belongs in my own portfolio and fits into my investing philosophy. Now, funnily enough, or coincidentally enough, today as I was going for a run, I was listening to Ausbiz The Core, and in an episode, I think it was from March the 9th, 2023, Centuria Industrial REIT was actually mentioned twice in that episode, and both experts said this was their favorite REIT on the ASX. So it was a good timing there to do a video on this particular REIT, and the very fact that two experts mentioned this REIT as their favorite REIT. So let's get stuck into the video and talk about Centuria Industrial REIT. For full disclosure purposes, I am not a shareholder of not only Centuria Industrial REIT, but I am a shareholder of absolutely no REITs at this point in time. And more than likely, that's going to continue through the future. I'm sort of giving some things away right now because after doing research on REITs, after doing research on Centuria Industrial REIT, I have no desire to take a position in any REIT right now. Now, just because I have no desire to invest in any REITs right now, or maybe forever, doesn't mean you don't have to. Maybe REITs really fit into your portfolio, fit within your investing strategy. And the whole point of me doing these videos is to share ideas with you. And a lot of videos I do on companies, more than likely, I'll never take a position in those companies. So it's all about learning new companies, learning about new investment vehicles, and deciding whether these companies, these investing vehicles like REITs belong within your portfolio, belong within your investing strategy. Now onto the particulars of Centuria Industrial REIT, looking at that portfolio. So they do have 88 assets. I'm not going to call them high quality assets as the management of this company has called them, because I just don't know. Maybe they're low quality assets, or some of them might be low quality assets. That's just the management talking up their portfolio. Portfolio value, $3.9 billion, and occupancy is quite high at 98.7%. And I would expect that to remain quite high, between, say, 95 and 100%. Maybe you don't want to be right on 100%. You want to be a little bit low 100%, because you always want some new tenants coming in. Perhaps I don't know anything about REITs at this point in time, so perhaps I'm wrong. Perhaps REITs are aiming towards 100% occupancy, but I haven't seen any REITs at that point. And WALE is a very important number. That is one thing a lot of REIT investors will look at. And for Centuria Industrial, WALE is 8.1 years. If you don't know what WALE is, it's just weighted average lease expiry. I talked about that acronym, about that bit of terminology in one of my REIT videos. Now on to their history. Now, a number of assets have grown from 50 to 88. That 50 was in financial year 20. Book value has increased from 1.6 billion to 3.9 billion. Average asset size has actually decreased from almost 20,000 square meters to just above 15,000. And occupancy does remain between about 97 and 99%. And WALE has also increased from 7.2 years in financial year 20 to 8.1 years in half year financial year 23. Now, geographic diversification. Now, this company has only property in Australia. 38% of their properties in Victoria, 29% in New South Wales, and 22% in Queensland. So the majority of their property are in the three biggest by population states, 7% in West Australia, 3% in South Australia. And when we look at the tenants, they do have an impressive tenant list. So 23% of the tenants are ASX listed, 4% are listed multinational, and 21% are multinational companies. And here are their biggest or top 20 tenants by gross income. By far, the biggest tenant is Telstra. Well, not by far, but the biggest tenant is Telstra with 9% of the total income. Then just behind Telstra, we have Arnott's with 7%, Woolworths 4%, AWH, which I believe is a warehouse logistics company, 4%, Visy 4%, Greens General Foods 3%, Fantastic Furniture 2%, a Reject Shop 2%, and right down the bottom, we have Yamaha at 1% and Amazon at 1% as well. Alongside Centuria Industrial REIT's half-year presentation, half-year menu release, half-year accounts, they also released a 104-page property compendium. So if you are interested in this particular REIT and you want to have a better understanding of their assets, all you have to do is go to this compendium. And they have a list of all their assets in this 104 pages. Not only do they have a list of all their assets, they have maps of where all the assets are located. And this is a particular map of Sydney and where their assets are within the Sydney boundaries. And by far, most of the assets in Sydney are in the western suburbs like Ingleburn, Smeaton Grange, Gregory Hills, Fairfield, Wetherill Park, Erskine Park. Many suburbs I have never heard of before, even though I've been to Sydney quite often. But most of the times I'm in Sydney, I'm in the eastern suburbs or near the CBD. Now, before I started doing any research on REITs, I thought the quality of REITs was quite low because they're investing in property, and my opinion on investment property was actually not that high for various reasons, which I won't get into this particular video. And the question I had as I started my research in this space was whether my opinion could change. And actually, that would be a good thing. You always want to have or be open-minded in about changing your opinion. So has my opinion changed? Do I think REITs are now high quality, particularly Centuria Industrial REIT? Well, not exactly. I still think REITs are lower quality type of investments, and that is important for me. So when it comes to REITs, even if I do see them possibly a good value, I'm less inclined to take a position in REITs. So I'm always looking at trends for lower quality companies. So if I do see changing sentiment in this area, changing a trend in the share price in REITs, that's when I might take a short to medium term. But I don't think necessarily REITs are the sort of investment you want to hold for the long term because I don't think they are high quality assets. Now let's have a look at some financial results for Centuria Industrial REIT. So in this particular slide, we'll look at their full year results for financial year 2022. The next slide, we'll look at the half year results for financial year 2023, just to see how things have changed for this particular REIT. Things shouldn't change all that much, but we will see a bit of a decrease or increase in the NTA, and maybe also the share price and market. Anyway, the share price on the 4th of August 2022, when they did release their full year results, was $2.98. And based on the shares on issue, which was something like 600 million, their markup was $1.9 billion. Now on to some important numbers. The funds from operation per share or per unit, which is sort of like the cash flow or the profit of the company per share, and that was 18.2 cents. Their distribution, which is just like a dividend per unit or share, was 17.3 cents. So you see here, if you divide the distribution per unit by the FFO per unit, it's more than 90% or around that 90%, which is very typical for REIT. So most of the money they generate in the operations by renting out their property, they give back to their shareholders in terms of distribution. So that's one of the attractive things about REITs is they are an income sort of investment vehicle. Now onto the NTA. So when they did release their full year results on the 4th of August, the NTA was $4.24. So that's significantly higher than the share price, which was $2.98. So if you divide $2.98 by $4.24, you probably get something like 0.7. So this particular REIT was trading at a significant discount to the NTA. And that's the reason I became interested in doing some more research on REITs, because a lot of REITs were trading at a significant discount to the NTA, and they're gearing 33.2%. That seems to be a typical gearing for REITs. Some REITs might be lower, some REITs might be higher. most REITs do have debt and they do use debt to buy more property, that sort of thing. They also raise capital to buy property as well, and Centuria Industrial REIT has done that over the past 10 years. Now to the half-year results, and the company's or the REIT share price has actually increased from $2.98 to $3.15, which means the markup of this particular REIT is now around $2 billion. FFO per unit, 8.5 cents. And remember, this is half-year numbers, but it's a little bit down from the previous half year. So if we take the last half of financial year 22 and this particular half year, the FFO in trailing 12 months is around about 17.6. So a little bit down from last year. Distribution, again, a little bit less than the FFO at 8 cents, but still payout ratio is more than 90%. And the NTA has indeed dropped, just like the market was expecting, down to $4.08. And right now, the discount of Centuria Industrial Property or Industrial REIT is not quite as much as it was 6 months ago when they released their full-year results. So just divide $3.15 by $4.08, and that is probably something like 0.75, 0.8. And the gearing has dropped as well, down to 31.6%. Now, one thing I didn't look at as closely as I could have when I did my research on REITs was just delving a little bit deeper into the debt of the REIT. So this is from their presentation of their half-year results. I just want to see some particulars around the debt, in particular, cost of debt and interest cover ratio and the gearing. So the cost of debt has increased from 2% to 3.3%, which is understandable because we do have rising interest rates. Interest cover ratio down from 5.4 to 3.8, and the gearing has dropped from 33.2 to 31.6%. And just by looking at the facility limit, around about 1.6 billion, and their drawn amount is right on 1.2 million. So they do have a lot of headroom, what they call it here, 375 million. So they can go out and buy more property, $375 million worth of property to add to their portfolio if they want. Now on to the first red flag I did find when I was doing my research on Centuria Industrial REIT, and that is the growth in revenue per share. In fact, there is no growth. It's going backwards. So in this particular slide, I'm looking at revenue and shares on issue. So if you weren't looking at revenue per share growth and you're just looking at revenue growth, you might come away a little bit more impressed than I was, because Centuria Industrial REIT has grown their revenue per year from $41 million in 2013, and this REIT listed on the ASX about 10 years ago, or just over 10 years ago. And in 2013, they had $41 million of revenue, which is rental income. In the most recent year, $203.6 million of revenue. So that's a nice growth in revenue. So that growth in revenue has been about fivefold over a 10-year period. That's the sort of growth you want to see. But the big problem here for Industrial or Centuria Industrial REIT is the growth in shares on issue. So back in 2013, the shares on issue was less than 90 million shares. Now it's up to 630 million shares. So shares on issue have grown more than almost tenfold over the past 10 years. In fact, shares on issue have grown at a greater rate than the revenue increase. And that means the compound annual growth in revenue per share is actually negative. Over the last 5 years, it is negative 2.6%. Over the last 3 years, it's negative 2.6%, exactly the same number. And this is a red flag for me. One of the things I am looking for investable, high-quality companies is growth in revenue per share. And I want to see at least 10% growth in revenue per share over the last 3 years, 5 years, and also 10 years. And we don't have that for Centuria Industrial REIT because they keep diluting shareholders and significantly diluting shareholders. And one of the reasons they get to buy more property is through debt and also by issuing shares to shareholders and to institutions. The second red flag I found when it comes to Centuria Industrial REIT was dividends. So I want to see revenue per share growing for a company or a REIT. And the other thing I want to see is dividends growing per year for a company. That's a really positive sign for a company. But if I see dividends dropping consistently from year to year, that's a massive red sign or red flag. And we see that with Centuria Industrial REIT. This comes from Combat. So hopefully Combat is right in their dividend page for Centuria Industrial REIT. And dividends have dropped. since 2015. That was a record year for the distribution payout to their shareholders, and gradually the dividends have gone down year on year. Now onto some valuation metrics. I just looked at a few here, including price to FFO, which is fairly similar to price to earnings, and price to FFO for Centuria was 17.9. Now, if I saw a price to earnings of 17.9 for a company that is not only not growing, it's actually going backwards, I would say that particular company was overvalued. But then if I looked at the price to NTA and saw 0.77, I thought maybe there's an argument that that company or that REIT is undervalued. And that's probably the way I would argue for this particular REIT right now, that there is potential, it is undervalued just by the price to NTA, and their yield, distribution yield or dividend yield, is at 5.3. So that's nice, but the way interest rates are rising, you could get a better risk-free return from investing in bonds at this point in time. So I don't see any attractiveness when it comes to the yield for this particular REIT at this point in time. One way I determine whether a company or a REIT might be overvalued or undervalued is just look at the valuation metric right now and compare that number to what you usually find for that company or REIT. So usually I look at the price to earnings ratio, price to free cash flow, price to operating cash flow. For Centuria Industrial REIT and for most REITs, I'll probably just look at the price to book ratio, which is fairly similar to the price to NTA. And you should see that the price to book for most REITs around 1. For higher quality REITs, probably just above 1. For lower quality REITs, probably below 1. And for Centuria Industrial REIT, their price to book ratio typically is between 1 and 1.25. Very rarely, and only once, has the price to book ratio been above 1.3. That was just before COVID-19. And very rarely, since 2014, has the price to book ratio been below 1. For a very brief period in 2018. And then recently, when I say recently, over a year ago, we started to see the price to book ratio for Centuria Industrial REIT fall. And that aligned, not coincidentally enough, when interest rates started to rise. So there is a correlation between rising interest rates and falling price to book ratios for REITs. In fact, the price to book ratio for Centuria Industrial REIT got to a low of 0.6 midway through 2022. It has been rising recently because share price of this REIT has been rising. But at 0.77, rarely, if ever at all, have we seen the price to book ratio of this REIT be this low over the past 10 years since this REIT listed on the ASX. Even during COVID-19 financial panic, the price to book ratio got as low as 0.8. So we are at historical numbers when it comes to PB ratio for this company. So you could argue, just based off the PB ratio of this REIT right now, it is undervalued, and more than likely, if you believe in mean reversion, eventually the price book ratio will get back up to between 1 and 1.25, where it usually trades at over the past 10 years. Now, so far in this video, I have raised a couple of red flags in regards to the quality of Centuria Industrial REIT. So revenue per share growth is going backwards, dividends actually dropping. But there is one sign that Centuria Industrial REIT might be a high quality company, and that is the chart. This is a high quality company or REIT chart with the share price going from the bottom left to the top right. This is exactly the sort of chart you want to see when you own a company for the long term. So maybe I'm wrong. Maybe Centuria Industrial REIT is a high quality REIT. Maybe there are some other reasons why dividends have been dropping, why revenue per share growth has been dropping as well. Because if I looked at this chart, I would say, and I would call Centuria Industrial REIT a high quality asset. Now, as I looked at that chart, which had all the hallmarks of high quality asset, I was thinking, well, how can that be? How can the chart have the share price rising through time, yet when I look at revenue per share and dividend, both of those have been dropping through time? So best way to look at this or think about this is the market was more willing to pay higher prices for this REIT, just disregarding all those other things about the REIT. And that's definitely true. In fact, when you look at the dividend yield or distribution yield for this REIT, it has been dropping. So back between 2014 and 2017, the dividend yield for this REIT was as high as 9% at one point in time. And then from 2017 all the way through to now, the dividend yield has been dropping. It got as low as 4% about 1 year ago. So this is another red flag, in my opinion, that the dividend yield of this REIT is falling, just like the revenue per share is falling, just like the dividend has been falling over the past 5 to 8 years. I plan to continue doing this Kneppy's analysis series for a while yet, and I am planning ahead. And the next 5 companies I intend to do a video on include Dicker Data, Macquarie Bank, SNL, which is Supply Network, Mineral Resources, and Index. If you do have a suggestion, a company you'd like me to look at for this Kneppy's analysis series, just leave that suggestion in the comment section of this video. Now, I can't promise you anything in regards to any suggestion you do leave in the comments section, but if it's a company I have not looked at or done a video on before, there is a better chance. If the company is profitable and if the company is growing, there's also a better chance I will do a video on that company. So again, leave the suggestion in the comment section of this video. But in regards to this video, that's all I have for Centuria Industrial REIT. If you do have any questions about this REIT or REITs in general, if you know a little bit more about REITs and you want to impart your knowledge onto us, I'd love to hear your opinion, your thoughts, so leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.